Welcome to the Deep Dive podcast, where we refuse to just skim the headlines. In the world of enterprise software, the stakes are too high for fluff. You need to know what's really going on beneath the surface.
Whether you're looking at a complex software implementation, improving your accounting controls, or a new security protocol, you need to understand how things really work when the rubber meets the road. I'm Ryan Caldwell. I'm here to help break down those complex ideas and systems so they actually make sense for your day-to-day.
And I'm Morgan Hale. I'm here to keep us focused on the big picture and ensure we get straight to the actionable insights you need to lead. Together, we'll talk with you like the advisors you'd hire to overhaul your tech stack.
We call this the Deep Dive. We are exploring the tools that power your business, from accounting and real estate to high-stakes security.
So if you're a CEO, a franchise director, CFO, or CTO, and you're looking for thorough analysis, you've found your home.
Let's get into it.
Let's dive in.
Welcome back to the Deep Dive. Today, we are turning our attention to something that sounds like maybe the least glamorous topic in corporate finance intercompany accounting.
Right.
But it's actually the hidden source of monumental pain for massive organizations.
It really is.
If you work for a holding company, a franchise, maybe a private equity group, any place where different legal entities are sharing expenses.
Software licenses, HR, marketing.
Exactly. You've got company A paying the vendor with cash, but company B and C are the ones who actually, use the service. They're the ones who need to pay company A back.
Mm-hmm.
So our mission today is really a shortcut. We're going to give you the architectural keys to see the difference between that painful manual way of doing things and the world-class automated systems.
We're talking account tech, Darwin.cloud.
Right. We're aiming for accounting that's so smooth, it's boring. And accounting, boring is like the highest possible compliment.
It absolutely is. And we should probably establish the real-world stakes here, because this isn't just, abstract bookkeeping.
No, it's very real.
This pain is rooted in business models where one company is basically acting as a temporary bank for its own internal clients.
Oh, okay.
Our sources give a couple of great examples from real estate. So think about traditional property management.
Okay.
The management company, that's entity A, handles a rental property, but that property is owned by a completely separate legal entity, client B.
Got it.
So entity A has to pay for emergency repairs, cleaning supplies, maybe property taxes, all out of pocket.
But that expense legally belongs to the owner, to client B.
Precisely. So entity A needs a perfect, fast way to get reimbursed.
Or the other example, the REO property,
Right.
real estate owned. So the bank has foreclosed and they hire a firm to fix up the house before they sell it.
Exactly. The management firm, our entity A, again, puts in the capital for new carpets, roof repairs, whatever it needs.
And then they have to invoice the bank, entity B, for every single one of those expenses before the sale.
Yes. And that whole process, entity A paying cash for an expense that belongs to entity B, that is the very foundation of what we call intercompany billing.
Okay, that context is crucial. The pain is definitely real. So let's unpack the core vocabulary here, because I feel like this is where the language itself gets a little confusing.
It really does. And the single most important idea for you to internalize is that intercompany AP and AR, it's not really about money leaving the whole group.
Right.
It's about creating a perfectly mirrored debt between two legal entities inside the same corporate family.
Okay, a mirrored debt.
The debt exists because one company got the service, but a different company paid the cash. So we have to define who owes whom. The sources are very specific here.
Okay.
The customer is the company that owes the money. They got the benefit but didn't pay.
And the supplier.
The supplier is the company that is owed the money. They're the ones who paid the external bill and now need to be reimbursed.
Wait, okay, let me just confirm that, because that's kind of an inversion of how we normally think about it.
It is.
So the property management company, our supplier, bills the property owner, the customer, for cleaning supplies. The supplier sends an invoice.
Correct. That's the charge for reimbursement. And the customer, the owner, they receive a bill they have to pay back internally.
And these are called, what, reimbursement or recovery?
Yep, interchangeable terms. And if you hear the term pass-through expense, it just means it's an expense that costs the paying company zero in the end because they know they're getting that money back.
Okay, that makes sense. And that brings us right to the traditional pain point, this pay-to-pay-from method.
The old way.
In legacy systems, this means people are forced to make manual journal entries, right, in both companies' books.
It sounds kind of unbelievable now, but it is so common. It's a retroactive fix. You've got two different accountants, maybe in two different cities, trying to manually create entries to balance a bill that was paid days or even weeks ago.
So it's slow, it's prone to typos.
It guarantees you have to do a massive reconciliation every single month just to find the mistakes.
Which brings us to the core architectural failure. I mean, this is what really separates the good systems from the bad ones.
This is it. The majority of systems try to fix it later with these journal entries, and that right there guarantees pain. It's the definition of a system that wasn't built for this.
So what's the golden rule then for a world-class design?
The number one rule is completely non-negotiable. Intercompany transactions must be created at the time of the transaction itself.
Not later.
Never later. If you let a bill get entered, paid, posted, and then you try to clean up the debt transfer afterwards, you've already failed. You've created an audit risk from day one.
And this flawed design leads directly to these three specific killers that break these systems. The first one is about symmetry, you said.
Exactly. Killer number one is posting only one side. You get a situation where Company A has an ICAP entry, they know they owe a debt,
Right.
but the matching ICAR, the reimbursement that Company B is expecting, it never gets created on their books.
But you're chasing ghosts.
You are literally reconciling ghosts. The two sides don't match and no one can figure out why.
Wow. Okay, and killer number two is about traceability, or the lack of it.
The total lack of it. It's using one generic intercompany clearing account.
Wow.
You'll often see it as like account number 2200, and everything for dozens of entities gets dumped in there.
Oh, no.
It destroys any chance of a meaningful audit. I mean, an accountant should be able to ask, why does our Boston office owe HQ $50,000?
It's a specific question.
Right. But with this generic account, the only question they can ask is, why does the giant $10 million number in account 2200 not equal zero?
It's just a mystery box of money. You've lost all the detail.
All of it. And that brings us to the final killer, which is timing, posting at different times.
Wow.
So say the original expense is booked on January 31st, but the accountant on the other side, they're out of office, so the manual ICAR entry doesn't get created until February 2nd.
So for 2 whole days, your balance sheet is just...
Yeah, it's wrong. And that might not sound like a catastrophe for one bill, but you scale that up.
Across thousands of transactions, it becomes this uncontrollable financial mess, especially a month-end close.
Catastrophic is the right word. You multiply that error by, 5,000 bills, 30 different companies, and a whole month of delays. You can't trust your numbers. You can't consolidate your financials.
And this all connects back to the brutal reality of the reconciliation process. If you contrast normal AP, which is one company, one cash account.
With intercompany, the complexity just explodes. You now have 2 companies, 2 general ledgers, 2 cash ledgers, often 2 currencies, 2 dates, 2 different people doing the entry.
So the accountant has to do what? Export 2 giant spreadsheets?
Yep. Export from Company A, export from Company B, and then try to manually match them up based on invoice number, date, amount. Maybe you're dealing with foreign exchange rates. You're just hoping the comment fields line up.
That sounds like a nightmare. Trying to match thousands of lines where the date might be off by a few days, or someone typed in the invoice number wrong.
It is chaos. And the cost of this, according to our source material, is staggering. Companies spend roughly 2 full-time accountants working 3 days every single month just on this.
Wait, 2 people, 3 days a month.
Which totals 72 days per year.
72 days of professional, skilled time just trying to match up money that never even left the larger company.
That's the insanity of it.
That number alone, 72 days, that should be the entire business case for getting a modern system.
It absolutely should be.
Okay.
So let's pivot. Let's analyze the world-class design. The account tech or Darwin cloud-grade architecture that just eliminates that 72 days of pain.
Okay, how do they do it?
All the top-tier systems, SAP, Oracle, NetSuite, OneWorld, they enforce this concept of the perfect mirror.
The perfect mirror.
They demand 2 key pieces of information on that very first AP voucher. The pay-to entity, so who legally owes the vendor, and the pay-from entity who actually paid the cash.
And the magic happens when those 2 fields are different.
That's the trigger. The moment those are different, the system knows it's an intercompany transaction. It automatically and simultaneously posts the ICAP on the incurring company's books.
And the matching ICAR on the paying company's books.
Instantly. No chance for a ghost entry.
So that simultaneous posting is the foundation. But it relies on a few specific architectural solutions to work, right? What's the first one that makes reconciliation obsolete?
The first is the unique IC transaction ID. Every single intercompany transaction gets a system-generated, unique ID that exists on both sides of the ledger, on the AP side and the AR side.
So reconciliation is no longer a matching game, it's just a binary check.
Exactly. You're no longer asking, does this $12,000 debit on company A match some credit somewhere on company B?
You're just asking, does IC transaction ID 492183 exist on both sides, and does it balance?
Yes, it turns hours of detective work into a 1-second database query.
Fantastic. What's the second solution?
The second is simultaneous posting in the same commit. Now, that's a very technical term.
Yeah, break that down for us. Same commit, atomic operation. What does that mean in plain English?
It means the system literally cannot perform the debit side without also performing the credit side. It's like a single unbreakable handshake. If the system, for whatever reason, fails to post the debit to company A,
it automatically cancels the credit to company B.
The entire transaction is rolled back. It's all or nothing. So there is zero possibility of the balance sheet being wrong for 2 days. It can't happen.
So that's the technological kill shot for killer number 3, the timing error.
Absolutely. And the third fix tackles killer number 2, that generic clearing account. It's granular traceability.
Okay.
World-class systems force you to track ICAR and ICAP by a specific counterparty.
Right.
You don't use account 2200 for everything. You have dedicated accounts like ICAR Parent Core or ICAP Boston office.
So if there's an imbalance, you know immediately which 2 entities are out of sync.
Instantly. And you can audit that one unique IT transaction ID instead of digging through a $10 million mystery account.
The beauty of this is that it shifts all the work from the end of the month, that painful reconciliation, to the very beginning, to the moment of entry. So when the actual payment happens, say the internal cash transfer, the system just uses that unique ID to settle both the AP and the AR side automatically.
And the result, as the sources put it so perfectly, is the goal. No floating balances, no journals, no reconciliation.
Let's bring this to life. Let's walk through the actual process based on the workflow they show in the source material.
It's actually deceptively simple. It happens in 3 steps. Step 1 is just setup.
Okay.
An admin goes in once and designates which companies can bill each other and assigns the right accounts. It's the basic plumbing.
Done once and then you're set.
Right. Then step 2 is execution. So a user is entering a regular bill, say a $1,000 bill from a consultant. They just check a box that says intercompany billing.
A single checkbox.
And then they can assign specific line items on that bill to a target company.
So they can split it?
Exactly. So on that $1,000 bill, they might say $321 a bonus for an agent bonus. That goes to the Lexington office. And then $555 for marketing. That gets invoiced to the Miami office.
So the company that's paying the consultant the full $1,000, they never actually record that as their own expense.
Precisely. The moment they enter it, most of that cost is immediately registered as an expected reimbursement, an asset, an ICAR from Lexington and Miami.
And step 3 is the result.
The user posts the bill, clicks Invoice Now, and the system just confirms. 2 invoices were created successfully.
And the key is what happens on the other side.
This is the absolute key. The receiving companies, Lexington and Miami, they immediately have a corresponding unpaid voucher, an ICAP, sitting in their own accounts payable.
Perfectly matched.
Perfectly matched to the source transaction, ready for them to pay back the corporate office. Zero manual work was needed to create the other side of that debt.
So what this all means for you, the listener, is that intercompany accounting is only hard when that logic of who owes whom is retrofitted, when it's an afterthought. When that logic is built into the architecture from the start, synchronized at the moment of the transaction, it becomes transparent, automated, and completely boring. And that is a huge success.
It is.
So to recap, the key to solving these massive time-sucking accounting nightmares isn't to hire more accountants to untangle spreadsheets after the fact.
No.
It's investing in better architectural design that forces that synchronization, using those unique IDs and that same commit principle right at the moment of truth.
And this core idea of moving validation and logic upstream to the point of entry to kill all that downstream pain, it's so much bigger than just accounting.
That's a great point.
I mean, think about your own organization's workflows. How many other processes, whether it's inventory, project management, even HR data, how many of them rely on a person manually checking or reconciling things after the fact? What kind of enormous organizational pain could you eliminate if you just move that logic, that verification, to the very first moment that data is ever entered into the system?
That's our show for today, about solving for the challenge of intercompany billing. Join us next time for another deep dive into an interesting, timely, or just plain complex topic in the world of enterprise software. See you next time on The Deep Dive.
Floating like a butterfly, no set afloat, sung like a lullaby. Brace yourself as the beat hits ya. Dip, trip.